Hello, good evening, good morning, wherever you are in the world. It's always 5 o'clock somewhere, right? Thank you for attending this version of Conversations with Rudy Rivera. I am happy to have again one of my frequent guests, Fred Egler. I feel like Johnny Carson, and you're one of my regular guests that come on all the time. Um,
As long as I'm not Don Rickles.
no, you're not Don Rickles and you're not Edmund Mann. So So I think it's a good start. I have with me tonight Fred Egler, who at one time was basically Chief Litigation Officer for PC Bank, has held many uh, prominent positions in companies and private law firms. Fred is an expert on lending, on litigation, and tonight he's going to talk about an area that's very near and dear to him, and that's private lending. Fred, you got to tell us what private lending is.
So there's been a lot of information in the financial press. First of all, good evening, everybody. It's nice to be here. A lot of stories in the financial press lately about private credit. The best way to explain private credit is to explain what it isn't. At one time, companies would, if they needed credit or a loan, they would go to a bank. Then, starting in the 80s, an alternative to that were high yield bonds, which came to be known as junk bonds. People may remember Michael Milliken was the king of junk bonds, and that involved lending by selling bonds at a relatively high rate of interest to the market that were held widely, and people could buy and sell the bonds. For various reasons, another alternative has arisen called private credit. And what it is a starts out with an investment fund, somewhat similar to a mutual fund, whereas the fund manager goes out and attracts investors who put money into the fund. The fund then takes that money and goes out and lends it on a customer by customer basis to borrowers who then use the money for their businesses, and they're supposed to pay the money back. These are typically longer term loans, 7 or more years. And they also, because of the nature of the borrowers, as we'll discuss in a minute, tend to pay a pretty high rate of interest. As a result, the funds themselves are attracted to many investors because until recently, these funds were offering double digit yields of 10, 11%, and in some places more. But the important thing to remember here is you have the investors on one side who have just put the money into the fund and collect the interest and then principal when the loan matures, and then the manager on the other side who picks the loans and deals with the borrowers. So that's what private credit is in a nutshell.
Well, why would they do that as opposed to going to a traditional bank?
So I have some slides that I think may help explain this. Uh, Let me just share my screen here. Uh, this first slide shows this is a 25-year period. What's happened in 2001, beginning in if you look at from 2000, this shows you the relative places of bank loans, high yield bonds or junk bonds, and private credit in the market. As you can see, beginning about 8 or 9 years ago, you had this surge in private credit. And there are three reasons for this. One is after the financial crisis, the Dodd-Frank statute, which Congress passed, required banks to hold more capital against their loans. If you have watched any of our other episodes, we did an episode where we talked about why banks are required to hold capital and what capital is. And so because of that, higher risk loans, which banks have to hold more capital against, became less attractive to banks. That opened the door to lending by what are known as non-bank financial institutions. In other words, companies that lend money but are not subject to the same regulations as banks, primarily because they don't take deposits and don't have federal deposit insurance. And so these companies were able to be more flexible and to lend money to borrowers that banks weren't interested in. The second
Well, one question, Fred, are they higher risk?
Yes, these tend to be riskier borrowers, and that is a good segue into my next point, which is that many of these borrowers are firms that were financed by private equity. That the private equity investors have gone out and purchased the firms, and then in order to allow the firm to continue to operate, traditionally private equity, what private equity tries to do is buy a firm, make it more efficient, and then after a few years sell it for a higher price. And one of the ways they do that is through leverage. So they borrow more money, and the firm then uses that money to expand. And those loans tend to be riskier, and but they pay a higher rate of interest. And so, because of that, these private credit funds, which were willing to take the risk as long as they could lend out the money at a higher rate of interest, became a much more attractive place for banks for private equity to go rather than to a traditional bank. The other thing that happened is that investors in these funds were attracted by the relatively long terms of the loans, as I said earlier, 7 or more years, and the high interest rates. And so, unlike banks who tend to want to move borrowers out of the bank at the first sign of a problem, these institutional investors, such as insurance companies and pension funds, were willing to let the manager deal with these loans on a long-term basis because they didn't need the money for 6 or 7 years. So as long as they were getting interest, they didn't really have to worry about it.
And that's
And
a
so
little
you,
different from the banks in the sense that most of the time, especially in the residential mortgage area, the banks unload the loans. Do the
right.
banks unload the commercial loans also?
Well, typically what the bank will do is it will slice up a commercial loan, a large commercial loan, into multiple pieces called participations. So while you may have taken the original loan from one bank, you may end up actually owing the money to 8 or 10 different banks. And one of the things that makes private credit more appealing to borrowers is that when the borrower comes back and needs some sort of concession, a change in the interest rate, change in the collateral, instead of having to deal with 10 different banks, all of whom would have to sign off on that, they can just deal with the private credit manager. And so they develop a long-term relationship with a single manager, and that's more attractive to the borrowers. So because private equity has exploded in the last few years, and especially in the area of software companies, as we'll talk about in a minute, this has led to a much larger volume of private credit loans, mainly because banks just aren't interested in that type of lending.
Well, banks are not interested in higher risk loans because they're more, I think, heavily regulated in a sense where
Well,
I think
they have to hold more capital against them, yes, which makes them less profitable. It
and,
reduces the return on their equity.
and private credit basically shops the market to see who's risk not risk averse, but risk inclined to for
Well,
in exchange for bigger payouts.
yes, and the private credit started as an investment that was attractive to institutions that didn't need the money for a relatively long period of time, but liked the high yield. And as I said earlier, that was primarily insurance companies and pension funds. Another trend that this has led to is, again, we had another episode about this. Many of these private equity companies have now come to control life insurance companies. And so the private credit funds have been used as investments for these life insurance and annuity companies that are controlled by the private equity companies. And because the life insurance or annuity company tends to have long-term liabilities, they can match the liabilities to the payoff dates on the loans, and they get a long-term investment at an attractively high rate of interest. So all these factors have encouraged an increase in private credit.
But do they invest in the particular project?
No, they invest in a fund.
In the
The investor invests in a fund that's run by a manager. What they're really doing is they're putting their trust in the manager. If the manager has a good track record and has run funds before that have produced good returns, then they'll go back to that manager when the manager opens another fund, and the investor doesn't really have to worry about the details of the loan. They just let the manager. They trust in the manager's judgment for that. Then they just collect the interest. That's what's
right.
supposed to happen. Now, as we'll discuss, that there have been these arrangements have run into problems.
Well, that's what I wanted to have clear, at least in my mind, and that is that I've got $1 billion, wishful thinking, right? And I go to you, Fred. Hey, Fred, high interest rates. I don't need this money for a while. So you invest it in what you need to invest it as long as I make money.
Right. There's that, and there's the high interest rate, and there's also the fact that because, so in other words, if I bought, let's say I bought a junk bond on a company that was a risky company, so that bond would have a credit rating. It would be a below investment grade. That's what a junk bond is. I could take that same money, go to a private credit fund. That fund would have, I don't know, 100 loans in it. And because you have the combined loans together, that's not considered as risky as borrowing from a single company, even though each individual company may be somewhat risky, but the chances are all going to fail at the same time are very small. So therefore, as an insurance company, for example, because I'm required to hold investments that meet certain regulatory standards, I can my private credit investment could be held as an investment grade rating, even though if I invested in each individual company, the the credit might be below investment grade. So that's another big source of appeal to these investment of these private credit funds to investors like life insurance companies.
But so they don't get involved in the project itself. They just, what I'm trying to get is they say, here's the money, but they can pick categories where they want to invest. In other words, I'm interested in the tech world, I'm interested in real estate, but do they
Well,
do they do they parse it by industry?
yes, the manager. Well, there's all sorts of different funds. The managers will provide details about the fund. They will tell there are what's called sector funds, which invest only in a particular line of business, like software. There are more diversified funds that invest in multiple different types of business, and then there are funds that are more that are set up based more on the maturity of the loans. Like you could have a 5-year fund, a 7-year fund, a 10-year fund. So all of these different varieties of funds are available to investors. The difference is it's the manager that's doing the picking and choosing among the actual, excuse me, borrowers, as opposed to a bank where the bank is looking at every borrower.
So it went from basically institutional lenders to retail lenders.
Well, as we'll discuss, as so often happens with Wall Street, as the product got more successful, Wall Street started looking around, the managers started looking around for more sources of funds. And yes, they began to sell some of these private credit funds at retail, and that's what's led to some of the recent headlines and problems, as we'll talk.
Well, but it seems like it's too good to be true. I mean, it seems like, wow, this is great. The interest is high, and from what I've gathered from what you're saying, the risk is spread out with multiple loans in one pool. Not all of them are going to go bad. How has the private credit gotten in trouble then lately?
So this all started last fall when there was a series of very highly publicized defaults, which we'll talk about. And the CEO of JP Morgan Chase, Jamie Dimon, was asked about this. And he made a comment that where there's one cockroach, there's probably more. And so this has led to a number. First of all, this cockroach comment kept getting repeated, but the point that he was trying to make is that these defaults that we'll talk about in a minute that became so publicly known might just be the tip of the iceberg, that these might be a symptom of bigger problems. And as it turned out, he was right. There are 3 companies that that were the source of the biggest issues. The first one is one called Tricolor, which was a company whose business was to sell cars using subprime financing to customers that would otherwise have difficulty getting credit. And then they would take these car loans and securitize them, meaning they'd sell them into the market in
Sure.
bundles. Well, as it turned out, what they were doing is that they were selling the same loans multiple times, which of course is fraud. And this was discovered, and they filed for bankruptcy.
Were
Shortly
there
after
any
that,
criminal prosecutions from that?
not yet, but it's still,
Still
all these
early.
ones we're going to talk about now are still ongoing. The next one was this company called First Brands. First Brands was a company that sold, basically acted as sort of a super wholesaler for auto parts, and had all these receivables from buyers of auto parts, whether they were, garages or auto parts stores or whatever. And a similar business model, they would take these receivables, the money that was owed to them by their customers, bundle them into securitizations and sell them into the market. Well, then they filed Chapter 11, and lo and behold, it turned out that they were selling these receivables, in some cases, multiple different the same receivable to multiple different people. Another big problem. So it turns out there is a shortfall of billions of dollars for the creditors of that company. And then the third one is actually a British company called MFS, which is a mortgage company. They were making residential mortgage loans in the market in the United Kingdom, and then securitizing them, similar to what Fannie Mae and Freddie Mac do here in the US. And lo and behold, it turned out that they were selling mortgages, the same mortgage, to more than one person. So this started to become a pattern and got a lot of attention. And especially because all three of those ones I just described, of course, are indicative of fraud, that people began to get nervous. So that's the first thing that happened. The second thing that,
Well,
go
no,
ahead.
go ahead. The question I have for you, the issue I see is criminal conduct.
Well, in those cases, there could well have been criminal conduct. It's all to be sorted out, but it's certainly fraudulent conduct. I mean, when you sell uh, when you sell these receivables or loans, the seller makes a number of representations and warranties, and one of them is that the seller has not sold the loan to anybody else. And
That's
so
criminal, Fred. I used to be a criminal defense lawyer.
yeah,
That
it could be. But of course, as you know, uh, whether or not something is a crime and whether or not you can prove it are two different things. The one thing for sure is that they borrowed a lot more money than they were able to pay back. And now these are high profile bankruptcies that have attracted a lot of attention. So investors started to get nervous.
But as a process, though, as a process, it doesn't seem like it seems like it could be a well-oiled machine.
Oh, there's
But
no question.
and it
Well,
also seems
and
go
one of the
ahead.
things that's one of the things the investment managers have been criticized here for is a lack of due diligence. In other words, uh, this
That's
is
what
an
I'm
exa-
getting at.
this is an example of what happens with electronics. See, before before everything was so digitized, for example, in the United States, when Fannie Mae and Freddie Mac would purchase loans from banks, which they still do, they would not advance funds until they actually received the paperwork on the loan. And I'm talking about pieces of paper.
Sure, sure.
Today, in these companies that we just talked about, typically they would just send out a spreadsheet with a list of loans and say, here are the loans, here are the amounts. This is your collateral, lend us the money. And the banks would do it. And there was not sufficient follow up to ensure that this was happening, to discover what they were doing until it became obvious that the same loans were pledged to multiple different people.
I think it's just a lack of governance. In other words, somebody's got to be managing the store, and let's assume there's no criminal activity. Selling a portfolio of loans to do different people is, if it's not criminal, it's definitely a lack of governance. And now, why it seems to me that it's riskier than in private equity than it is with regular banks.
Well, yes and no. I mean, actually, banks lent to all three of these companies too. These were not just private credit issues, and everybody missed it. And the reason was, this gets back to this idea of high interest rates. A lot of investment decisions are made because people are chasing yield, especially during the period when we had relatively low interest rates. And when you get an investment that says, "Hey, we can pay 10 or 11%," well, you're going to close your eyes to a lot of things if you're getting 10 or 11% every month, because these companies paid out for years until they didn't. And so people are blinded by these promises of high returns.
Madoff made money until he didn't.
Yes, well, now, of course, Madoff is somewhat different because Madoff is a situation where he actually had no investments, and that was a complete fraud. That's not
No,
this
I
case.
get it. It was a Ponzi scheme, but as long as people were making money, more people were investing. It's just that
Exactly.
eventually it caught up to him.
Exactly. Well, as the famous line, of course, is by Warren Buffett: "Is when the tide goes out, you find out who's not wearing a bathing suit."
I think I'm going to borrow that from Warren Buffett. I like that.
But let's get back to some of the other sources of problems with private credit, because the second one is something that's also been in the news lately, and that's AI. Uh, the recent developments of AI have convinced a number of investors that many of these software companies, which provided applications to businesses, were not viable in the long term because AI now allows people to do what's called vibe coding, if you heard of that,
Yes.
where you can create code yourself and create custom made software yourself. Well, if you're doing it yourself, you don't need the software company. And this has scared a lot of investors. And if we look at this chart, which shows what's happened to the stocks, and these are big companies. These are not small private equity companies like we're talking about. These are big software companies. And you can see what happened to their stocks at the end of 2025 and early 2026. They all crashed because of fears about AI. And so what has happened is that investors have become much more jittery about the fate of these smaller software companies, and they are no longer seen as good investments. And private credit, as it turns out, has large exposures to these software companies because of their relationship with private equity. You can see here the Wall Street Journal recently reported that private credit has significant exposure to these companies. And although the so again, people start to get nervous because they're looking at these loans and saying, well, hey, wait a minute, these loans don't pay off for 6 or 7 years. These companies might not be in business for 6 or 7 years. And so that is what has started to make people nervous about these companies. Uh,
I saw, Fred, I saw where a number of the mega companies laid off a number of coders because they thought AI could do it, be more efficient, they'd be faster. In fact, they're slower now, not as productive, and there have been some accidental erasures of terabytes of data by AI.
Well, again, it's too soon to know whether or not any of this is going to happen, right? It's too soon to know whether or not AI is going to wipe out the whole software business. I mean, we're talking about developments, in the last 6 to 8 months. But what this has done is it has given people reason to be nervous. And as we'll see, that's what about the long term. And private credit is all about the long term. And that's what's caused this problem. Uh, so as people have started to look into this more, what they've realized is that many of these private credit loans aren't even though they're reported as performing by the managers, aren't actually generating any cash. That the see a because these many of these funds are private, they do not have to report the current value of these loans. All they have to do is keep paying out interest. And so, what many of these funds have done is they've found a way to keep loans current, even though they're not paying interest anymore. And one of the ways they do that is what's called a payment in kind, or PIK. And what this is the kind of loan that you and I could never get. Let's say that I have a loan with a private credit fund, and the end of the month comes, and they say, "Okay, where's your interest payment of $1 million? Where is it?" And you say, "Well, I'm a little short this month." Now, if you or I did that on our credit card bill, we'd be in default. But what many of these private credit payments have done, funds have done, is that they have agreed to accept, instead of cash to pay off the interest, an additional loan. And that's called a payment in kind, or PIK. And so all that does is it pushes the obligation to pay the interest to the end of the term of the loan. And that allows them to continue to report the loan as performing, but in fact, it's not generating any cash. So you ask, well, now where are they getting the money to pay their investors? Well, the answer to that is leverage. So many of these funds, in addition to the money they get from the investors who are supposed to be paying out, who are supposed to be receiving interest, in order to enhance the performance of the fund will also go and borrow money from banks. And that will give them more money to allow them to acquire more loans. But it also, so what they have done is they have used those loans to pay off, continue to pay interest to their investors. Now, this works for a while, but sooner or later, something's got to give. And this next slide shows sort of the progression of what can happen here. And this is a list of the different types of vehicles that own private credit. And you'll see here in the slide, there's reference to BDCs. BDC stands for Business Development Corporation. And it's a kind of misleading term that was created by a section of the Internal Revenue Code that gives special tax treatment to companies that lend to businesses under certain conditions. So many of these private credit funds are what's called BDCs. But some of them are publicly traded. So for example, you could go out and buy stock in a BDC and the stock would go up and down. And those companies do have to report the value of their loans. However, many of these firms are not publicly traded. And so they are not necessarily required to report the current value of their loans as long as they're making payments. However, what's happened is that the investors in these funds that aren't publicly traded have seen that the prices of the stock in the publicly traded funds are going down. And they say, oh, wait a minute. These publicly traded funds are holding the same kind of loans that our fund is trading. So therefore, there must be a problem with these loans. So I want out. And that is what is causing the problem, because the industry has started to sell these BDCs, stock and shares in these BDCs, not just to pension funds and to life insurance companies, but to retail investors. So as we look at this graph from The Economist, you see what's happened here is that the big growth in credit in the last few years has not been in the publicly traded business development corporations, BDCs. That stayed about the same, but there's been a huge growth in these non-traded BDCs, which do not. And so what that means is that the company that is issuing those investments does not have to markets loans to market. They can continue to keep valuing them at 100% as long as they're paying out interest. And a lot of that, you look at that big red, that big section of red at the end of that graph, a lot of those investments were sold to retail investors. Now, a retail investor's attitude toward a period like this in the market where there's uncertainty about credit is very different than a life insurance company or a pension fund. A life insurance company or a pension fund can say, well, things may be bad now, but I don't need the money for another 5 or 6 years, so I'll just let it ride. Plus, I got all these other things that I've invested in, so I'm not too concerned about it. A retail investor looks at this and says, I don't want to lose money. I want out. And so what's happened is a lot of retail investors are asking to get out of these private credit funds, and that's what's caused the problem. You may have seen in the papers, the financial press, there's been a lot of publicity about this company called Blue Owl. And Blue Owl is one of the big sponsors of private credit funds, and they have sold a lot of funds to retail investors. Typically in one of these funds that is not publicly traded, you cannot go back to the fund sponsor and say, give me back my money. Typically, they will redeem up to 5% of the fund each quarter. That's it. And so if you want more than 5% of your money back, you've got a problem. And starting a couple of months ago, a number of these funds, including Blue Owl's funds, started receiving redemption requests from investors way in excess this 5%. And so they're trying to figure out, well, what the heck are we going to do here? Because this is what's known as a gate. And a gate on a fund uh, means that you no longer have immediate access to the fund. The fund manager has the right, they're not required to, but they have the right to say, no, we're limiting it to a certain percentage each month. And they are very reluctant to do that because once they start doing it, then people think, uh-oh, there must be a problem. So now I really want all my money back. And then they have trouble. Two things happen. First, they have trouble attracting new investors. And second, people tend to question the credibility of the manager because, why isn't he giving me my money back? Blue
Well,
Owl,
it's like a perception that a bank is closing when it's not. And
exactly.
people think it's a perception issue.
Right. And so on this one fund in particular for Blue Owl, what they did was they essentially liquidated the whole fund. They said, all right, we'll just give everybody all their money back in the hopes that that would make people less nervous about their other funds. But that's not what happened. And now this is spread to many different managers. So that if we look at these asset management companies that are big sponsors of these private credit funds, and these are just three examples, Apollo, Ares, and Blue Owl. This is a chart of their stock prices. And you can see they've all gone way down since the beginning of the year. Now, of course, their stock market in general is down since the beginning of the year, but these have gone way down. And the reason is that these private credit funds are being subject to a very high level of redemption requests because people are scared that there are going to be a lot of defaults and the funds are going to be worth much less than people say much less than the managers say they are. Now, the question is this really true? The managers have said that this is not a problem, that there are just sporadic defaults, that people are panicking. And it is true that they have continued to attract new money into their funds, much of it from pension funds and institutional investors. So the reality is nobody really knows. You do have it is true that you have a much higher level of redemption requests than they have experienced in the past. And so therefore, that has made it much more difficult for these funds to operate. And it's also made retail investors much more reluctant to get into private credit.
Well, even at 5%, if you have every one of your customers wanting their 5%, that's still a significant amount of cash that you've got to lay out.
Exactly. And so this has raised a lot of questions about the future of private credit. It just more or less by coincidence, within the last month, the Labor Department has come out with new rules that would make it much easier for employers to include funds like private credit funds and also private equity funds in 401k plans. Right now, they're not allowed in the 401k plans. And ironically, if they're run right, a private credit fund is a pretty good match for a retirement fund because, you put your money in a 401k and the way it's supposed to work is you're not supposed to touch that money until you retire. So it can sit there for years. Or, the investment that returns 10, 12% for 7 years, that's a pretty good retirement investment, especially because, 401ks are tax advantage and you're not paying the money on the interest income. However, as we know, retail investors don't really act that way. They tend to be nervous. And when they start to see things going down, they tend to want to sell. And so it's not really clear that this
they want to cut their losses.
Well, it's the old saw is that the worst time to sell is right after something has gone down a lot, because chances are if you hang on, at least some of it will come back.
Oh, sure. You hang on to a stock, you only lose money if you sell it. But
Right.
but if I'm a retail investor, what kind of due diligence can I do?
Well, you're back to the same problem, which is you have to rely on the manager. Now, with a 401k, it's a little bit different because the employer, the sponsor of the plan, which is almost always the employer, does have a fiduciary duty to offer only prudent investments to the participants. So this is another problem where all of a sudden you're seeing all these private credit funds with high levels of redemption. Chances are the sponsors are not going to go anywhere near a fund like that because they're afraid they'll be sued for offering an investment that's not prudent. So it's going to make it much more difficult for these types of funds to be offered to retail investors. That's one thing that could happen.
But in the
The big
401k though, they would diversify the investments more. So you have a loss in one industry, it's not going to affect the whole fund.
That's true. It shouldn't, but each investment is judged on its own as to whether it's a prudent investment. So there could be this is an area where there's a lot of litigation. There are a lot of class actions brought against fund sponsors for 401k investments that don't perform well, and this is a place that this is a type of investment that a sponsor may just not want to touch if he sees that people are running for the exits. So on the
Well,
retail side, it's the current situation is going to make it much more difficult for these managers to continue to offer these types of funds at retail. Now, the bigger problem, of course, is whether or not these recent defaults are indicative of some broader problem in private credit. Because if that's the case, you could have what's called systemic risk, where you could have large defaults. And if it does start to affect the institutional investors, like the pension funds and insurance companies, that it could cause their solvency to be called into question. As I mentioned earlier, and as we discussed in another episode, a lot of these types of investments have been put into life insurance and annuity companies that are now owned by the private equity companies, because the insurance premiums have become a big source of funds for the private equity sponsors. And so if those investments start to go south, and that causes the insurance company's solvency to be called into question, that's a much, much bigger problem. Then you have the whole question of how this affects private equity, because private equity has already been struggling for a while now to continue with its traditional business model, which is buy a company, load it up with debt, and then sell it for more money to pay off the debt. They've had a lot of trouble providing what's referred to as exits for their investors. In other words, to get the company sold after they've bought it, for a number of different reasons.
well, they're learning the hard way. It's easy to get in, but hard to get out.
Exactly. And so because of that, these private equity sponsors, may find it that it's no longer attractive for them to borrow money from these private credit funds, because the companies simply aren't performing well enough to service the debt. So you could have a negative effect on the private equity firms as well. But the big problem is that, if you remember that first slide I showed, where if you look at the overall increase in credit in the economy, credit to businesses over the last few years, the vast majority of it has been outside the banks. In other words, bank lending to businesses has not risen very much at all. And as a percentage of total lending to businesses, it's gone down. So the slack has been taken up by these private credit vehicles. And if they start to become less attractive to investors, that means they'll have less money to lend to businesses. And that means that lending to businesses overall will become tighter. And that means that the economy will not grow as fast, because ultimately, in order for businesses to grow, they need capital. And this type of lending is a major source of capital. So that's probably the most significant effect that we'll see from this, that is just
Fred,
going to tighten credit for business.
I see this having a domino effect. It's going to go across multiple lines, I believe.
Well, see, this is the great unknown. Everybody, the managers keep saying, "Oh, well, this is a relatively small percentage of our loans, and this couldn't possibly ever get as big as the great financial crisis in 2008, where everybody starts going belly up." Well, that may be true, but that's kind of a false dichotomy, because it could be pretty bad and still not be as bad as 2008.
Well, I
So,
don't know that anything will be as bad as 2008. I'm
well,
surprised more people didn't go to jail. Uh,
let's hope not. Let's hope not. But you still could have a significant reduction in the availability of credit to business, which is bad for the economy.
that's I see as a big issue because if the money dries up, if these private equity companies can't get the funds to go in and invest in these projects and traditional banks aren't willing to lend them, what alternative do you have?
Right. Now, another thing that we really haven't talked about here is that one of the other big uses of private credit has been to finance these data centers. And I'm sure that you've seen these stories about these enormous data centers that are being built. And many of them are being financed by the uh, internally by the big, what they refer to as hyperscalers like Google and Amazon and Microsoft, so that they're not actually borrowing the money. But many of them are financed by debt, more and more of them now, because of the enormous amount of money that's being poured into it. And some of that is being financed by private credit. And many people think that the data center craze is overbuilt and that eventually there can't possibly be a need for as many data centers as are being built. And if that happens, that could be another threat to these private credit funds. But again, nobody really knows what the answer to that is.
Well, and these data centers are not easy to put up, and they require an exorbitant amount of resources. And you put up more than you need, you're talking about significant losses.
Well, one of the arguments, again, this is all to be determined, is that the approach of it to AI in the United States is a winner take all approach. In other words, that somebody's going to develop the killer app, the super duper AI, whether it's what they refer to as generalized in, artificial intelligence or something that's going to be smarter than everybody else, and that's going to be the solution. And then when they do that, all the other providers are going to lose out. Now, whether or not that actually happens, nobody knows. But if it does happen, that means there's going to be a bunch of data centers that aren't being used, and there's not going to be any money to pay for it. And so that is a significant potential risk.
But don't you think that there should be somebody forecasting this stuff, and they don't always seem to get it right?
Well, I mean, there's all sorts of forecasts. I mean, you can read you could go out today and read 20 different forecasts about, what's going to
Yeah.
happen with AI, what's going to happen with private credit. But the reality is a lot
Which
of
one do you
the,
believe? Which one do you believe? Which one's correct?
well, not only that, but I mean, the capital requirements for AI and data centers, the way it is being approached in the United States right now, are unprecedented. I mean, you are talking about hundreds of billions of dollars being spent on these projects. And nobody really knows whether or not that is uh, a, a project of that size over that long a period of time is likely to succeed. But because of the potential returns, which of course are enormous, uh, and because you have these giant tech companies that have so much money anyway, they're willing to take the chance. They see it as existential. They see it as if if we're not number one, then that's the end of our business. But everybody can't be number one.
It's not for the faint of heart.
Well, yes and no. I mean, look, if you had put your money in uh, what they call the Magnificent Seven, the big seven tech stocks in the last 8 or 9 years, you would have made a hell of a lot of money. And these are the same companies that are now all in for these data centers. So it's right now it's regarded. I mean, the debt that is being issued on these data centers because of the way the transactions are set up is investment grade debt. It's AAA rated, but that doesn't mean that the borrower couldn't default someday. There were a lot of residential mortgage-backed securities that were rated AAA, and a lot of them defaulted. So people can make predictions and projections, but they're only as good as the underlying assumptions.
Yeah, but the problem with those was that the mortgages weren't AAA rated. They were C rated, but they were being sold as AAA rated.
Well, it was financial engineering, right? But I mean, in these just give you an example, in some of these data centers, you have a data center operator that is I don't know, spending, let's say they're spending $100 million on building this data center. And the data center uh, is based on, and that they sell debt. Let's say they sell debt that's 20-year debt. Okay. Now they've got a lease from Facebook or Google or someone to run the data center. So they have the income to run the data center, but the leases may only be 5 years long. Well, what's going to happen in 5 years? Now, of course, what they say is, well, it's Google and they're good for it. So, of course, they're going to renew the lease. But that doesn't necessarily mean that's going to happen. It's because, AI, think about how fast things have moved with AI. I mean, in 5 years, things are probably going to look very different, but nobody really knows exactly what they're going to look like. So that's a significant amount of uncertainty, and a lot of that uncertainty is going to be transmitted into the credit markets. See, because the other effect of all this debt that's being issued for data centers is, I mean, there's only so much money out there to buy this stuff, right? It's crowding out other borrowers. And so as it crowds out these other borrowers, those borrowers either have to pay a higher rate of interest or they can't get loans at all. And that's another factor that is again going to probably result in the less available credit to the typical run of the mill business as opposed to some giant tech company.
Right. No one's immune. I don't care how big you are. No one's immune from the economy.
Well, of course not, but there are degrees of risk, and you can you can companies, rather investors are, all other things being equal, some of them are required to, like a life insurance company is required to purchase only investment grade credit, and so they're going to use their money on that. And that's where, and then other borrowers are, other investors, as we've discussed, are attracted by these high yields. And that just means that as you get to the bottom of the stack, the borrowers at the bottom are going to pay more, or in some cases, not be able to attract any credit at all.
If the retailers want out, then who's left?
Well, the traditional investors in these types of funds are institutions, right? Primarily institutions that have long dated liabilities that they need assets to match up with. For example, an annuity company knows that it has all these liabilities to pay out benefits, but they also know that a lot of them aren't going to start for 10, 15, 20 years. So they're more than happy to take a long-term investment as long as, number one, it's highly rated, and number two, it pays out a good rate of interest. Whereas, so they don't really care that the value of the loan may go up or down over time, because they're more than happy to sit there and wait for the payoff at the end of the term. Most retail investors can't do that. Now that type of demand will continue, but the problem is if a lot of the existing debt starts defaulting, then you've got number one, the people are going to be much less likely to invest in similar debt, and number two, then potentially you've got a problem that threatens the stability of the company and maybe of the financial system.
See, I think from what I've read, the growth of private lending is basically outpaced transparency, risk controls, and regulatory oversight. A lot of the data is not necessarily, reliable. There's, they don't disclose loan level data publicly. They mark assets infrequently and subjectively, and often value loans at par, even when the credit quality deteriorates.
Well, see, this is you can argue that this is an effect and to a certain extent a measure of success of the Dodd-Frank statute. It pushed all this borrowing out of the banks and has reduced the risk that the banks take. So in that sense, it did what it was supposed to do. However, it pushed it into a bunch of non-bank financial institutions like these funds we're talking about tonight that, as you point out, are not subject to the same regulatory oversight. They're not subject to the same accounting rules. They don't have the same capital requirements. And as a result, it is less transparent. And so the question is, where at what if things do start to go bad, uh, can number one, can people catch it before it gets really bad? And number two, is it setting the stage for some sort of systemic problem that ultimately would require another government bailout?
Don't you think that investors, are not able to see a true default risk and problem with leverage embedded in funds and also correlations across portfolios? Those are other issues.
Well, I think people are just willing to ignore that. A lot of people are willing to ignore that stuff if they're getting 11 or 12% a month, right? They're just willing to ignore it. They go along for the ride. I mean, that was the great genius of Milken with junk bonds. In the old days, nobody would even consider buying a bond for a company that was, not rated investment grade. But, Milken realized that you could sell them and that there were people who were hungry for yield who were willing to buy them. So, you can make an argument that private credit is safer because your risk is more diversified. There's multiple borrowers, but as you point out, you don't really know that much about any of the individual borrowers. So, to a certain extent, you're basically relying on the expertise of the manager. That's really what it comes down to.
Well, but in the downturn, though, wouldn't you have gating withdrawals, forced restructuring, and also fire sale pricing too?
Well, see, this is what the gates or the restrictions on withdrawals are trying to avoid. In other words, if somebody goes in and says, let's say 50% of the investors want their money back. Well, it's one thing to maintain an internal value on these loans of 100%, even though they could be marked down lower. But then if you have to go out and sell the loans in the market, well, then that's when you're going to find out what the real price is. And if you have to rapidly sell all of the loans, yes, that you could have a fire sale and severely deplete the fund to the point where it might not be adequate to pay off all the investors. That's one of the purposes of gates, to make it to allow the manager the discretion to hang on to the loans for a longer period of time in order to weather these difficult periods.
I don't think private lending has been really tested in a real recession like 2008.
Well, essentially, there was no. I mean, there was no private lending at the scale it was today in 2008. I
Right. That's why
mean,
it hasn't been tested yet.
yeah,
If
right.
we get another recession like 2008, what does that do to private lending?
Well, I mean, a recession like 2008 was bad for all lending, so I don't know that you can really compare it to that. But even in so you have
Well,
two
my question
problems.
is, would it be worse? Would it be worse if we had the
Well,
recession of 2008 for private lending?
well, there's two issues here, right? One is just a general economic downturn, a general reduction in economic activity, and the value of these loans is going to follow everything else down. So, it's not clear whether they would do better or worse than everything else. The bigger problem is if you have some sector related problems that are unique to the sectors where private credit is concentrated, especially in software. I mean, that's what people are really worried about. I mean, if it really is true that these software companies' business models are kaput and there's all this debt outstanding to them, then some of these funds are going to have major, major problems.
And do you think these funds are basically ecosystems for conflicts of interest?
Well,
The
I don't
same
know that.
firm managing private equity and private debt?
Well, so if you have the same manager who is managing the company and is then managing a fund that is lending money to the company, yes, that's obviously a conflict of interest, and you'd like to avoid that. Although I suppose you could do it if you disclosed it. But I think that is less of a problem than just the problem that there is this sort of world of private equity, right? And that some of these managers are managing debt and some of them are managing equity, and everything is private. So nobody is really sure uh, how close the values that the fund is declaring are to actual market values until you try to sell something.
Yeah, I think there are incentives to extend and pretend, rather than to recognize losses. Oh, everything is fine, which goes to those loans you were talking about earlier. The
Yes.
kick
Now,
the
of
can
course,
down the road.
yes, the payment in kind transactions. Now, of course, that is not unique to private credit. I mean, banks have done extend and pretend for years. One of the reasons you haven't seen after COVID, the value of some of these of many big office buildings in the United States just plummeted because of work from home. And one of the reasons people were afraid there were going to be massive defaults. That didn't happen. One of the reasons was because of what we call extend and pretend, that the banks just continued to grant extensions, and many of the value of many of the properties came back. Not all of them, but many of them. So you didn't have this disaster that you would have had if they all went bust at the same time. So extend and pretend is not always a bad thing.
Fred, we covered quite a bit. This was super fascinating. So the whole area of lending, I had to read up a lot before you came on because to
Well,
me,
you're talking
lending is
about
lending. Huh?
You're talking about big numbers here. I mean, the private credit, the entire amount of private credit in the United States outstanding now is in the trillions of dollars. So it is a substantial. I mean, if you remember those first couple of slides we looked at, it is a substantial part of the commercial credit universe today. So however things end up here, it's going to be a significant impact on the availability of credit in the U.S. in general.
A number of fund type people have said to me, and I believe this to be true, it's easier to raise 600 million than it's to get $1 million loan on a house.
Well, a corollary to that is that the the two people who are most likely to be hired by a bank are somebody who's made $100 million on a big transaction and somebody who's lost $100 million on a big transaction. Because if you've lost $100 million on a big deal, the
You've
bank will
made
say,
it. You know,
"Oh, well, somebody trusted him with all this money, so he must know what he's doing." So there is some truth in that.
well, Fred, we're at the end of our time. I wish we can go on longer. This is pretty fascinating. I want to thank my LinkedIn audience for attending, my Zoom audience for attending, and this will be shown on YouTube. Those who want to see it, it'll also be shown on LinkedIn. The recording stays there. Thank you, everyone, for attending, and I will see you for the next episode.
Thanks,
So,
Rudy. Always a pleasure.
take care.